We are going to have a discussion. So what we're discussing here is a really innovative new method for portfolio optimization. Pause. And its fundamental goal is to achieve the absolute minimum tracking error variance. We'll be using the Finance Research Gate website for our work, as is our usual procedure. But before we proceed with that, it's important to fully grasp the underlying mathematical principles. First, we have two portfolios. Our main one, the returns of our portfolio, and we are comparing its performance with the benchmark. Normally, we have a distinct difference on average between the two elements. So on average, we will always obtain an alpha value, which precisely quantifies this difference. However, we aim to construct a portfolio and consequently identify the optimal weights for its constituent assets. The goal is to ensure this portfolio exhibits the absolute lowest possible variance in its performance difference.
The difference between the portfolio's overall performance and the benchmark.
So the minimum, or more accurately, the primary objective for the portfolio optimization process is to minimize the variance of the tracking error, where this tracking error is specifically defined as the difference between the portfolio's overall performance and that of the benchmark. The variance of this specific magnitude is certainly going to be minimized. We are not going to minimize the average difference between the portfolio and the benchmark, as a difference typically exists. Instead, we will minimize its variability, the level of variability that occurs over time, and also the difference that exists between the portfolio's actual performance and its benchmark. This is what we refer to as the tracking error. Therefore, our primary objective is to minimize this tracking error. So let's start with the very basics of this concept. Imagine we have a collection of several assets, each with its own return, and we need to determine their individual weights. Then, if you take the calculated weight of each specific asset and multiply it by its corresponding return, you will then arrive at the overall return for the entire portfolio. This is how we construct the portfolio. Now then, it's important for us to grasp how the variance of any given variable is actually composed. Specifically, this variance is comprised of two distinct terms. The first of these is what we call the expected square term. And from that, we then subtract the square of the expected value of the random variable. So while they might appear quite similar at first glance, they are fundamentally different. Now consider the first scenario. We take the value and square it across the entire duration. What happens is, for every single period, we first square that specific value, and only after that do we calculate the overall average across the entire time frame. In this first scenario, we calculate the average of the value over the entire time, and then as a final step, we square it. So the squaring operation here occurs only once. However, in the second case, it happens within every individual time period. The y here can represent any variable. Near and pause. Let's consider the actual difference, which is our primary objective to minimize. Pause, that is the tracking error. What is the connection between this particular term and variance? Imagine, for example, a specific situation where we are observing a particular difference. This difference is not constant. Instead, it fluctuates and changes over time. This means that during certain periods, we might find it to be positive, while in other distinct periods, it could become negative. Consider this: if we square a value, then the resulting deviation, irrespective of whether it was initially positive or negative, the final difference will always become a positive number. However, when we calculate the average of these differences across a period of time, we effectively eliminate any positive or negative deviations that might occur. This means that the resulting term primarily reflects the inherent variability of the measured variable itself. So, we can now proceed to accurately write down each individual component of this complex system
for each and every one.
So, for this particular element, which we require in this analysis, because this is indeed the major part, it can be regarded as a constant, because once we take the expected value over time, we will simply have a number and then we square it. Therefore, there's nothing that we can truly analyze within it. In this context, we're looking at a number of different terms, and these are the specific terms that have been written down for you. The first term in our analysis, the initial component, is specifically the portfolio's overall return, which is then squared. And then we also have to account for the co-movement, or the way they move together, between the portfolio's actual return and the return of its designated benchmark. So here, the variable y once again represents the difference between RP and RB. This specific term, RP, stands for the portfolio return. It's called RP because when we multiply the individual weight invested in each asset, we effectively create a complete portfolio. Therefore, what we'll have is RP, which signifies the overall portfolio return. A benchmark return is quite simply a single numerical value. This benchmark itself is a time series, and our primary goal is to compare our own performance directly against that specific benchmark's historical performance. At this point, this specific portion of the discussion can now be committed to writing.
When we refer to this specific term,
Once more, as we've previously discussed, this specific term shown above essentially represents the overall portfolio's return. This is precisely because when we multiply the individual weight assigned to each asset by its corresponding return, the final result we obtain will be RP. So we are taking the return and squaring that value for each period of our portfolio and then averaging them over time. How does this then relate to the overall concept of variability? A larger numerical value indicates that the portfolio itself will fluctuate quite strongly in its overall magnitude. However, in this case, we are specifically studying the variance of the actual difference. Now, considering that the RP, or the relative performance, directly contributes to the overall difference, it follows that a larger squared value of this RP component will typically lead to an increase in the tracking error, unless this effect is effectively counteracted by a very strong synchronized movement with the established benchmark. And this is precisely the reason why we need to introduce and consider the second part of our analysis here. But focusing on this part, yes, if we have larger squared values of the portfolio return, this will inevitably lead to a more significant and indeed a consistently elevated level of variability within the tracking error. Now, let's direct our attention to the weights. The t is transposed in this spot. Then we have the omega. The omega is simply the n by n second moment matrix, a fundamental component. Let's consider a scenario where we possess two distinct assets within our investment portfolio. In such a case, we will observe the expected value of the squared return for one, and conversely, on the other corresponding diagonal position, we will find the expected value of their cross product. This is not the same thing as a variance-covariance matrix by any means. It's simply the value of the squared return on cross products. That's all it is. These what we commonly refer to as omega. But if you multiply it by the weight, not just once but 2 times, then what we will get is this result. It's the portfolio return squared within each period and then average across all time periods. So this is the initial part. The second crucial element we're examining is the covariance, or as we might also describe it, the co-movement. This specifically refers to the relationship between the returns generated by our investment portfolio and those of the designated benchmark portfolio. Within this particular aspect, we identify a primary and significant component, which we will refer to as gamma. And gamma here is simply the co-movement that exists between the portfolio's overall return, which is specifically the R without any subscript, and the benchmark's unexpected surprises. So that is the specifically measured component of the second term. And that particular metric will accurately represent the overall investment portfolio's actual return when it is then multiplied by the unexpected fluctuations or unanticipated movements within the benchmark's overall return. A higher value effectively reduces tracking error, primarily because it helps to counteract and balance out any significant fluctuations or larger movements within the portfolio. So even if you experience substantial portfolio movements, as indicated by the squared RP over time, this higher value will ultimately help to mitigate and offset that tracking error. The primary reason is that when the market benchmark itself begins to move, it consistently moves in the very same direction as our overall investment portfolio. This crucial alignment then effectively helps to minimize any potential tracking error. These are ultimately the two fundamental components we consider. Here, identifying this specific variable and also this other crucial component, both of which are integral to this particular equation. Now, following this, our next action involves carefully extracting these two relevant terms, and our primary goal is to then perform a minimization operation upon them. All other elements can effectively be treated as a constant value, and consequently, there's no need for us to minimize those. Our primary objective is to minimize the specific variable component which directly contributes to the calculation of the tracking error. So, what we're looking at here is the squared portfolio return. A greater value for this metric suggests a more significant tracking error. From this, we then subtract any shared co-movement that exists between the portfolio's return and the unexpected movements of the benchmark. As previously discussed, a higher degree of co-movement will tend to effectively offset any significant fluctuations within the investment portfolio, thereby reducing the overall tracking error. We are operating under the influence of this particular limitation. This specific restriction is quite inherent and entirely commonplace. Let's consider a scenario where we have a time series with a clear, consistent upward trend. We'll refer to this as R or RP, representing the return of our investment portfolio. Alongside this, we also have the corresponding benchmark return. It's important to note that these two series exhibit a perfectly correlated relationship. The difference in this specific case remains constant, and therefore the variance of the tracking error is precisely 0, which is the absolutely perfect estimation that we are always striving to achieve. However, on average, we consistently observe a noticeable difference as they are not truly identical. The reference point does not lie exactly on its counterpart. This is simply not the case. We have a difference. That constant difference on average is what we refer to as the alpha. So when you add this alpha component to the average benchmark performance, that will then provide us with the average value of the portfolio's total return. This is a very common and understandable reality that we all face in life. Consequently, if we choose to ignore or minimize its importance, we will undoubtedly find ourselves subject to its consequences. And then, as the next logical step in our process, we can proceed to apply the Lagrangian function. To construct the Lagrangian function, we begin by taking the primary objective that we aim to minimize, which in this specific instance is this particular term. Following that, we subtract the product of lambda and the set of constraints. It's crucial that these constraints are formulated to have we need to have a zero on one side of the equation. If it's not already in that form, then you'll need to rearrange terms. In this particular case, we already have it set up on one side. Since the other side is zero, we then take the remaining side, this expression, and multiply it by lambda. We multiply it by 2 as this is a simple mathematical operation which will make it considerably easier for the subsequent step, allowing us to take the common term and then solve the equation. So, essentially, it functions merely as a scaling factor, meaning it holds no significant importance when we consider the fundamental logic that underpins the process of identifying the minimum tracking error portfolio. And once we have constructed the Lagrangian function, we then proceed to take the derivative with respect to w. And here we'll encounter this specific term, which is the inverted form of omega. And omega, to reiterate, represents the n by n second moment matrix as shown here, specifically for an example involving two distinct assets. This visual representation illustrates precisely what the omega matrix appears as. We take the inverse of omega and then we will multiply it by. Now, the concept of gamma, it primarily concerns itself with understanding the mathematical product or the synchronized co-movement between the overall return of an investment portfolio and the unexpected surprises or movements observed in the underlying market benchmark. So once we perform the inversion of the omega matrix, we are then able to obtain the complete and final solution. But the crucial question that arises is, why does this specific inversion operation consistently occur every single time we are performing portfolio optimization? In previous lectures, when we were solving for other portfolio optimization problems, we generally followed a very clear and structured process. Specifically, once we had successfully found the inverse of the second moment, which is often represented by the variance covariance matrix, we were then able to directly arrive at the optimal solution. The fundamental reason behind this is that the inversion process will invariably select only those assets that are truly independent, or demonstrates its own unique independent variation, and consequently it will assign a much lower weight to those assets that are either highly volatile or simply redundant within our specific portfolio. For example, the system will identify and select the assets that show the highest potential. It exhibits a strong tendency to move in close alignment with any unexpected shifts or surprises that emerge from the benchmark. This effectively minimizes the discrepancy between its own performance and the benchmark, thereby significantly reducing the overall tracking error. Alternatively, it strategically selects underlying assets that inherently exhibit less volatility and more stable price movements over time. This method is crucial for minimizing the tracking error. Therefore, the inversion technique employed here, combined with other relevant terms, will effectively accomplish this task by identifying the optimal weights that ultimately lead to the smallest possible tracking error. So, to apply this concept, we'll be using the Finance SH Get website. We need to navigate to the time series section because that's where we can access our portfolio data. Let's imagine that we have chosen the monthly data covering the period from the year 2000 to 2010. After that, we would then click on Apply to Charts. Our next step is to proceed with Series A. It is within Series A that we will establish the benchmark portfolio. Therefore, we should enable and ensure this section remains open. First, we need to carefully choose the appropriate metric, which serves as our primary input variable. In the specific example we've been considering, our focus was on evaluating performance, specifically as it's measured by the financial return. Consequently, for this analysis, we will proceed to select the monthly return as our key indicator. And for our benchmark, we're going to select the sector option. So we will then filter all our data based on sector. And after that, we'll specifically choose the industrial category. Once we have successfully completed that initial phase, our next step will be to calculate the sector index return. This particular sector is composed of a significant number of individual firms, well over 100. 200. All right, let's try to get this particular task completed rather quickly here. Then we'll need to filter all of this data by its specific sector.
And then you apply.
So in this specific situation, our objective is to determine the average monthly stock return observed across all of these various companies. And then for each distinct time period we analyze, we will establish a single consolidated value that represents this entire sector. Therefore, what we're essentially doing is constructing a specialized index specifically tailored for this particular industry. Once we finished, we will then activate Series P. In fact, at this point, we're going to select our portfolio. And for example, let's assume our portfolio contains 3 stocks. For each individual ticker, we simply search for the correct one, and then from the drop-down menu that appears right here, we can easily select and pick these 3 specific firms. And these firms belong to the industrial index. So it makes sense to create a portfolio of stocks that share similar characteristics to the benchmark, specifically sharing the same sector. Following that, we proceeded to apply a series of specific filters, and then we activated the dedicated portfolio management section, where we carefully selected the objective of minimizing the tracking error. We went ahead and selected a simple covariance estimator for this particular task, and then, as is our customary approach, we simply accepted all the default settings for everything else that was required. Now we must carefully determine the risk-free rate, which is, of course, the annual percentage rate we're using. For our purposes, let's just set it at 2%, and then we also have to select the benchmark series. Remember, we had chosen A before, so let's go through that entire process again here. And then we just press the Run button. In this particular situation, our objective was to construct a portfolio that would achieve the absolute minimum possible tracking error. Here we have the 3 specific stocks along with the corresponding weight that's invested in each one during every single period. It's important to note that we aren't creating just a single fixed portfolio that remains constant throughout the entire sample period. Instead, we actually construct a new one each and every month. So what we're essentially doing is a rolling, continuously updated portfolio construction.
Note that the first month isn't 2000.
The reason for this is that we required the initial 12 months to establish and build our very first portfolio. Subsequently, in each month thereafter, we meticulously repeat this entire process, aiming to construct a portfolio that achieves both minimum variance and minimum variance tracking error. The portfolio's composition is directly determined by the specific investment weight allocated to these 3 particular stocks. It's important to note that the individual weights assigned to them must always sum up to exactly 1. To give you an example, when we examine the most recently constructed portfolio, the minimum variance tracking error was found to be approximately 66.5 for this particular firm. And then, for another firm, it stood at 10.7%. And the figure we're discussing is 22.8% within this firm. You can effectively measure the out-of-sample performance of the model, which upon careful review appears to be quite robust and impressive, especially considering that the crucial Sharpe ratio is significantly above 1. Furthermore, you also have the capability to thoroughly measure all of the relevant in-sample characteristics and descriptive statistics. Also, it provides quite impressive figures regarding the average monthly return, and the standard deviation is not particularly high when you compare it to individual assets or other investment options.
Other series. To illustrate, in our specific example here, we had the benchmark series.
So for portfolio B, we quite simply selected just 3 individual stocks. We began with what we considered a normal average value for them, but that specific value wasn't our main focus, because our goal was to then build a complete portfolio by incorporating these 3 stocks. And in conclusion, we were pleased to see some very positive numbers. This concludes our comprehensive overview of the minimum tracking error variance portfolio. We sincerely appreciate you taking the time to watch this presentation.